I'm Ernie Humphrey, Educational Programs Leader for Performative, the largest community for corporate finance, accounting, treasury, and related leaders. I'd like to welcome everyone to today's webinar, Best Practices in Understanding and Increasing Your Company Valuation. Often company valuation feels more like a black art than a science. Today's experts from Rose Ryan and Assay will help us demystify the key drivers behind company valuation. You will learn how to identify and manage key factors that can impact your company's valuation and discover specific actions you can take to determine a valuation strategy that goes beyond a benchmark. You will also learn what it means to truly have your financial house in order, how basic financial practices can impact valuation, and how to avoid common valuation pitfalls. A quick note on today's agenda. First, we'll hear a presentation from each of our featured speakers. Then we'll move to our interactive Q&A session where we will spend the remainder of our hour. We would like this to be an interactive experience for you. So if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your questions. We can't promise to get all of them in, but we will do our best. And we'll follow up afterwards on any questions we did not get to. A few logistical notes about the webinar. The link to today's presentation and video recording of the webinar will be sent out to all attendees within 24 hours of the event. Those who would like CPE credits will need to answer all polling questions during the event and should have pre-registered for CPE credit. For any questions on CPE credits, please send an email to cpe@performative.com. Again, we encourage you to ask questions on today's topic via the questions box in your GoToWebinar control panel at any time during the webinar. Finally, you'll be asked to take a short survey today regarding the webinar. We greatly appreciate your feedback regarding our event today, as we always strive to improve the ROI we offer our event attendees for their valuable time. A quick word about Performative. Performative is the largest online community resource for senior-level corporate finance, accounting, treasury, and related leaders. Performative connects corporate finance leaders to provide instant advice and insights on the tough financial and strategic challenges they face each day. Okay, let's get started by introducing today's first featured speaker, Kathy Ryan, CEO, Rose Ryan. Kathy founded Rose Ryan 20 years ago, and it has become a leading Bay Area finance and accounting consulting firm. She has served as an interim CFO at more than 50 startups, mostly in the high-tech sector. Early in her career, Kathy was Director of Finance at Quantum with responsibility for worldwide budgeting and forecasting and cost accounting, and served as a tax manager at PwC. In 2012, she was named one of the most influential women in Silicon Valley by the Silicon Valley Business Journal. Kathy holds a BS in accounting from Santa Clara University. With that, it is my distinct pleasure to hand the floor over to Kathy Ryan, CEO, Rose Ryan. Kathy, please take it away for us. Thank you very much.
Great, thank you. So today's agenda is short, but we have a lot to cover. So I'll be discussing how companies can reach and maintain a benchmark valuation or share price in their industry sector. Adrian will discuss how to go beyond benchmark and achieve a premium on your share price or valuation. And then as Ernie said, we've also reserved about 15 minutes at the end of the presentation to answer any questions that you might have. So with that, let's get started. So on today's webinar, we have a number of different types of companies, from public companies to VC-backed private companies to family-owned businesses. So all are interested in understanding and increasing their company's valuation, and each will come with a different perspective as to how their share price, in the case of a public company, or their valuation, in the case of private companies, is determined. So, and while each company is different, the nuances between each market and the underlying best practices are similar. So bottom line is that companies need to prove that they have assets that someone would buy and that their risks are mitigated. So when I think about understanding a company's valuation, I think of the children's game Chutes and Ladders. So in Chutes and Ladders, good deeds are rewarded by moving up the ladder. Bad deeds result in falling down the chute and suffering the consequences. So think of your company's valuation in the same way. Being prepared and implementing the right strategies will be rewarded with increased valuations. Ignoring financial basics or not developing your strategic assets will result in a slide down the chute, and most likely leaving a lot of money on the table. So my part of today's webinar will be how to avoid the chutes and what are best practices to stay neutral or at benchmark in your company's valuation. So all companies in any given sector, whether private or public, have an industry benchmark multiple at which they trade. So this is clearly visible in public markets where companies trade at different multiples of earnings. Some are trading above benchmark, others trade below. So analyzing any company report will show that much of its content is what's driven by what I call below benchmark information. So what does this mean? From an investor's perspective, if a company is not taking action on certain factors, then it does not trade at industry benchmark. For example, if the company is not managing its profit lines effectively, it's not managing its revenue and costs, or if it's failing to manage its liabilities, the company will most likely be trading below benchmark. So as you can see, 2/3 of these factors revolve around your company's financial results. So a good part of my presentation will focus in this area. And the context for best practices is financial integrity and preparation. So financial integrity is more than not having misstated or fraudulent financial statements. It's much broader and includes assessing your risks, having the appropriate internal controls in place, and if they are in place, are they being followed or ignored or subverted even? Do you have the right talent in place at the right time performing the right job? Does finance have a long-term strategy in place? And is your department set up not only to do today's job, but also tomorrow's and in the futures? So using this definition of financial integrity, it's obvious that it's not something that a company can generally get done in a couple of months. Knowing what's needed and then having a culture or a mindset of financial integrity throughout a corporate life cycle will save time. It will help ensure credibility, reduce risk, reduce uncertainties, and then help a company reach a benchmark valuation. So I've listed a few points on how not to get discounted, and we'll talk about each of these in more detail throughout the presentation. So the only one that I'll address now is external factors, the last one on the list. External factors tend to be somewhat out of a company's control, but can have a huge impact on share price or valuation. Certainly the biggest one that almost all companies have recently faced is the financial crisis and the subsequent recession. Other external factors can include loss of FDA approval or a technology shift in your market. So a couple of examples of the latter includes the touchscreen technology that's impacting companies that manufacture keyboards, mice, and other computer peripherals. Another example is the shift from digital cameras to the wet screen technology. So these external factors can be challenging and require companies to be strategic and nimble to adjust to the changing markets. So let's start with your financial statements. They must be in good order, whether you're private or public. So for private companies, your company should have available detailed financial statements and supporting information for the past 2, or better yet, the past 3 to 5 full years, plus the most recent stub period. In looking at your financials, you should also consider the following. Do you have external verification of reported results? So audited financial statements are certainly best practice. If audited financial statements are not available, then is there some other attestation or third-party records or support that support the numbers in your financial statements? You should also consider the relationship of your reported results to management presentations and other key financial metrics or business metrics, and they should all tie. You should consider the ability of management and the accounting systems to provide detailed supporting documents necessary to support what you have in your numbers. And finally, you need to consider the nature and extent of adjustments to reconcile detailed information to the financial statements, including any year-end audit and other adjustments. So in other words, you should know what's in your numbers and be able to support them. I had a client where we were brought in to help on due diligence for a target company. And the target company took quite a bit of time in producing the financial statements when asked. So the result was that the target was seen as a higher risk. Management was seen as not being in tune with their business, which was all taken into account in assessing the purchase price for the target company. We've also taken on clients with cash basis financial statements and where fixed assets are treated as an operating expense. So again, this does not help management's credibility or the company's valuation. And then finally, we did have one client who did not have audited financial statements. It was impossible to produce them within the 2 to 3 month window that was given to us by to the client by the acquiring company. So the result was a derailed acquisition and with the buyer pulling out. So the same applies to public companies, but public companies are regulated and therefore have much tighter reporting requirements than private companies. They are used to producing their external reporting financials and related documents on a regular basis. But because of these external reporting requirements and the tight deadlines, public companies may be able to close their books on a timely basis and have systems and processes in place to accomplish this. Woe is the public company, and I've seen some where most of the supporting schedules are all on Excel. We also see small to mid-sized public companies, as well as those in rapid growth that may be lacking the talent needed to address some of the complex accounting and finance issues that are more commonplace than, say, 10 or 15 or even 20 years ago. So not addressing this issue in time, the staffing and technical issues can lead to errors, missed deadlines, and especially employee burnout. So the effects can be cumulative. So year 1 and year 2, under these circumstances, they may be okay, squeaking by. But by year 3 or 4, the situation is untenable. With respect to a company's disclosure committee, the SEC is more focused on enforcement than ever before. So a tip to avoid a call from the SEC's Division of Enforcement is to boost your disclosure committee process. So even companies that, quote unquote, play by the rules can still be at risk for misleading investors unintentionally by omitting or inadequately disclosing important information from their SEC filings. So disclosure committees are key to preventing such issues. But in our extensive experience working with public clients, we have found that disclosure committee process leaves much to be desired, and more often than not doesn't support its intended purpose. So it's important that the committee understand their oversight responsibilities and how they can best contribute to the process. So having financial statements in good order is important because all investors use them to understand how your business is being managed. And certainly having your revenue and costs in control are critical importance to the investor. Assets and liability are also critical and can result in even deeper discounts if not managed. So take idle cash. Significant idle cash can signal to an investor that management is not using cash to grow the business. And so what may feel right to management, which is having a lot of cash on your balance sheet, waiting for that rainy day, it can signal the opposite to the investor. Companies can also have obsolete assets on their books for a variety of reasons. It could be in order to meet bank covenants, they don't want to take the write-down, or they just may not know what they have. So we had an example of a client, it's a large public client, with significant fixed assets that had not been inventoried in a number of years. And so the company really didn't know what they owned, what still existed, and what the value was. So this can become apparent in any kind of a due diligence process. So it's best to understand what your objectionable assets are. More typical on the assets with private companies are what might be deemed to be personal assets on the record. So I had a client looking to acquire a small private company. And fortunately, so this was good news, we were provided 2 sets of financial statements, one that tied to the accounting system, and then a set of adjusted financials where the owner's car hobby was excluded. So the owner was upfront about what the real assets of the business were before any serious negotiations started. With respect to your intangible assets, and I just listed a few here, know what you own. Understand the chain of title or license to your intellectual property from your employees, your contractors, and from any third-party transferees or grantees. If you don't know or haven't executed the appropriate contracts, then you may not own the most important assets in your company. Contingencies and other liabilities can have an impact on a company's valuation or share price as well. Liabilities and contingencies equal risk to an investor. So lawsuits, whether pending or threatened, increase the risk, thereby discounting a valuation. Lack of an accounting system and necessary processes can also create liabilities. So for example, the lack of a system outside of Excel to track the product returns at a client resulted in a significant understatement of their warranty reserve, which led to a restatement of prior earnings, which then resulted in a drop in their share price. 3 common underreported liabilities include tax issues. So tax issues are typically sales and use taxes, VAT issues if you're doing business in a foreign country, and payroll taxes around the employee independent contractor issue. Environmental issues can also be underreported liability, especially if you're a manufacturing company. And then last, any violations of the Foreign Corrupt Practices Act, if you're doing business overseas, is just a nuclear explosion waiting to happen that can increase your costs and your liabilities. So we could spend another hour just discussing these issues. My message comes back to being prepared and financial integrity. So don't ignore or wait until it's too late to identify and address these issues. So as I stated at the beginning of the presentation, a company wants to show that they own assets that someone is willing to buy and have mitigated their risk. So a way to mitigate risk that all companies, big or small, private or public, can have include 1, financial planning. So financial planning helps management team know, hey, this is where we are today. This is why we're where we are today. And then this is where and how we are going to grow the business. Financial plans do not get put on a shelf either. It's management's responsibility to have the discipline to use the plan to cover how they're doing against plan and to develop key metrics, business metrics, to run their business. Also, having your corporate records in order is really important. I listed some of the areas where I've seen that are missing or not taken care of. Others could be customer contracts, license agreements, employee contracts or employment contracts, and assignment of invention contracts. There's also corporate governance, which can include internal audit, SOX, and ERM. So again, every company, no matter their size, should have a system of internal controls that are in place to protect the assets of the company. The most critical aspect of a system is the tone at the top. A company can design a great set of controls, but if they're ignored or if they're discounted by management, they will most likely be ineffective. The idea here is to get something in place that's meaningful, not something that just checks the box, but something that's meaningful and right-sized for your company. An ERM program is another means of risk mitigation and can rescue your company from unforeseen catastrophes, like a major supplier going belly up, or a natural disaster, or an armed conflict that shuts down important operations, or an epic PR crisis. So done right, ERM makes the day-to-day decision-making smarter and more strategic and more sharply focused on key success factors. And it doesn't have to be giant time or a money-eating monster. So simply put, an ERM program identifies business risks, key business risks, in every aspect of your operations and gives management the knowledge needed to develop a plan to reduce those risks. Every mid-sized company, public or private, can do this and should with a program that's right-sized for their business. So the topics that I have been discussing all drive to create confidence in the management team. It shows that the CEO and CFO and other members of the management team are managing all aspects of the business. They're organized. They're prepared. So if you remember my analogy to chutes and ladders, a company's valuation or share price can take a big tumble down the chute if investors lose confidence in the management team. So a recent example is the BP stock right after the oil spill in the Gulf of Mexico a few years ago. So while unknown liabilities were also a factor, the BP CEO taking a vacation during the crisis resulted in a lack of confidence in the management team and in the CEO, which then resulted in a significant drop down the chute in their stock price. So investors want management teams that can demonstrate that they're able to make hard decisions and that they know what they're doing. So I have an example of a company. This is a public company where I've charted the stock price of a company, and it's the key milestones or events at the company in the last 2 years. And so first, the company was trading between $10 to $13 per share prior to FDA approval. So that was at the beginning of 2012. And then, as expected, the share price significantly increased with FDA approval and continued to increase over the next several months. Then the company missed its revenue targets. The revenue projections were higher than actual results. The stock was discounted because of missed revenue, so a key element of the P&L. A proxy fight started and continued for several months. Proxy fights are never pretty, and investors began losing confidence in the management team, a bigger discount than the missed revenue projections. And then finally, the proxy fight ended with a new CEO coming on board. Within a month, the new CEO resigned due to unforeseen circumstances, and another CEO was immediately brought on board. But 3 CEOs in 3 months. Investors have lost confidence in the management team, and the stock is trading below $10 a share today. So the company has quite a bit to do to move itself back up to the benchmark. So to summarize, to reach benchmark, companies should be focused on their P&L, their revenue and costs, their balance sheet, assets and liabilities, and their management team. They should be identifying and addressing their weaknesses in these areas. Start early, be prepared, and address the problems. These factors help get you to industry benchmark. Without them, you're leaving a lot of value on the table. So my part of the presentation helps a company get back to benchmark. Adrian will next discuss how a company can go up the ladder and achieve a premium on its share price or valuation. So I thank you for your attention today. So before turning the presentation over to Adrian, I think it's time for our first polling question.
Thank you very much, Kathy, for your great content and insights and sharing with us for what it means for a company to truly have its financial house in order. I'm going to go ahead and launch our first polling question today. The first polling question is asking for a high-level assessment of your company's current understanding of what can detract from your valuation. As a reminder, those of you after CPE credits for today's webinar need to answer all 3 polling questions during the webinar. Of course, we appreciate everyone's consideration in answering our polling question. We hope this polling question will help inspire your questions. We encourage you to please ask questions on today's topic via the questions box in your GoToWebinar control panel. I'm going to go ahead and introduce our next featured speaker as we wind down the time allotted for our polling question. Our next speaker is Adrian Bray, founding sponsor SA. Adrian is a founding partner in SA, an international advisory firm specializing in increasing multiples beyond the benchmark by blending traditional investment banking with proprietary business process. He has worked with businesses in all major industries and has founded, built, and led businesses as a CFO. Adrian is also a founding partner in SA's sister business, Strelaz, an international business consulting and coaching firm helping clients drive enterprise valuation. Adrian has both a CGMA and an ACMA as an international management accountant. I'm going to go ahead and close the polling question here. And with that, I'm going to hand the floor over to Adrian Bray. Adrian, the floor is now yours. Please take it away for us. Thank you very much.
Thank you, Ernie. So, thank you, Kathy. Great points. And typically when we go into businesses, all the points that Kathy has raised are there. They are there in some shape and form. I've never come across the perfect business yet. So this is a huge topic, the building blocks of value. I can talk for days, if not hours, and maybe years on this. So I'm going to try and keep this brief. And really, the first thing I'd like to kind of bring to the attention, and certainly it was a little bit of a conundrum as a finance person myself, is these building blocks of values are actually intangible. So if they're intangible, and how on earth are we going to measure them? So probably the first thing to do is actually look at, well, let's look at what drives our business. So as Kathy was talking about our balance sheet, and really, if we look at what drives most trading businesses, is a P&L. But what drives the P&L? And really, what we do is go in and help organizations realize that what drives their P&L actually has an impact on their multiple. So these strategic assets are really hard to measure, but you have to demonstrate specifically that you've got them. So they don't typically come from the accounting statements. The results come from the accounting statements. So if we look on the public markets, then you typically see an immediate reaction when announcements are made, both good and bad. As Kathy was showing you, the FDA approval. Well, the FDA approval was seen as a strategic asset, and it was expected that company could maximize its revenue, so there was huge expectations. Then when it missed the revenue targets, the question was, did they really have the assets and the capability to maximize that? So what I'm going to do is talk about these intangible assets and really the impact on the future, and the reinvestment that happens from your balance sheet items and your strategic assets is also of importance to whether you're looking at an investor or your own business. So if we just look at the public markets, because what happens in the public markets equally happens in the private. It's just instant in the public market, and the private clients that we deal with only find this out when they come and have a valuation or come to prepare their business for sale, raise capital, and so on. So typically, as Kathy was talking about, there's the industry benchmark. And then as she talked about the chutes, this is where the chutes come down, is where your business is considered as underperforming. Same applies in the public domain as it does in the private. Similarly, we all hear these wonderful stories and hear these share prices where we move into the outperform. This is where the multiples go through. So what we're going to do is just really, if you just look at what Kathy says, then the challenge is, as finance professionals, is having a really strong balance sheet and P&L at best gives us the industry benchmark. The key thing we have to demonstrate are these intangible things called strategic assets. And the challenge that we see is if you're dealing with investors, it's like having a Japanese and English conversation. They absolutely understand the financials, but when CEOs are often speaking, CTOs and other executives speaking, they don't realize that specifically what they're saying is like they're having an English conversation and the investors are having a Japanese conversation, and they both think they understand each other. So if I just take then the concept that in a simple valuation for a trading company, it's profit times a multiple. And in this case, what the multiple is about, the industry multiple, they're about a calculation. It's a scientific calculation of the expectation of future profits. And what we find is most people have a really strong business plan for P, for the profit, and very few companies actually have a plan for the multiple. And the reason for this is training in the multiple is not given in any business or accounting courses. It is actually specifically a maths in finance. So what we do is work with clients to help them build an equity storyboard that they can actually start managing against and managing the relationship with their investors. When we're dealing with private clients, we're building that valuation story so that they know what they're driving to. So if they want future capital, they take less of a dilution. And if they're looking for sale, they get the maximum price and the minimum amount of reps and warranties because we've cleaned up all the below-the-line issues. So as Kathy was saying, the first step in all of this is you could have all the wonderful things above the line here, but if you've got issues down here and below the line, then unfortunately it is like Chutes and Ladders. It's easy to get discounted and very hard to get step-by-step up these ladders. And each rung is important. The order, there's an absolute specific order that investors will give you credit for. So given the wide group of participants, I was asked to do some best practices. So just very quickly, if we look through for private and family-owned businesses, is I come across a lot of businesses that have a secret sauce. The challenge is they don't know how to maximize that secret sauce. So knowing the secret sauce, understanding the drivers for today, not just today's revenue, but what's going to generate tomorrow's revenue. Kathy talked about understanding external trends. Well, if you understand your secret sauce, you can actually work out how to grow your business in a different way. Use a business plan, even a one-pager. Monitor against the plan to learn. It's not about beating yourself up about not getting the plan. It's why aren't we getting the results, or why are we exceeding the results? Create a valuation plan. Understand how the multiples work in your industry and how your secret sauce can apply. Hire the team that can help drive the multiple with the right skills. Get them doing the right things. I come across many organizations coming out of the recession, both public and private, that have a whole series of executives that were sleeves rolled up, hands-on. Now as the recovery starts, they need to backfill those roles so that the executives can drive the business. Understand where you're allocating resources and what the return is you're expecting. Understand what's required for today's operations and understand what investments you need to make for tomorrow. And one of the biggest things I see with management teams, both private and public, is understand the risk profile and how that has an impact into the conversation and the drivers. So if we look at a private company with an external investor, it's all of the above. There's a few extra things. One of them is really understand your financial partner's expectations and their time horizons. Is it the same or longer? What's going to change that? Really get clear on what their expectations are. I've come across a number of businesses where the external investor has signaled they're not happy with the growth, and somebody has built a business for 20 years can suddenly feel like they're losing control. You need to have an equity or valuation strategy plan because whether you realize it or not, they are driving to a valuation. Well, if you've both got the conversation and you know what assets you're supposed to be building, then this helps you to be aligned. Again, we're back to building the team. As Kathy says, if there's concern about the management team, they're going to discount you. If you need more capital, they're going to dilute you further. And hugely important, create board presentation from their perspectives. It absolutely needs to have the numbers, but it also needs to demonstrate what strategic assets you have, what are being built, and how they're being deployed. The challenge, of course, with financials, as we know, they demonstrate the past. They prove what's happened. Within this board pack and within investor, you need to consistently demonstrate how you're driving the future. And ultimately, you have to prove these intangible assets that you're building. Same with the public. Different language I talked about earlier is you need to have a share price strategy, not just how you're going to drive the revenue and the profit side, but also the multiple. You need an equity storyboard 3 to 5 years out that helps drive your investor relations messaging, actually helps drive the business strategy because these are the things that you're building. You need to actually critically look at your presentation review. Is it in their language or is it in yours? Is the industry acronyms rather than it's in the financial speak? Conduct external benchmarks to understand the impact. I've come across many CEOs who say, I've got a whole group of investors that don't understand us, yet are driving boardroom decisions. So in understanding your investors, and really be honest, do the investors understand you? And I've covered it a few times now, just make sure all your communications are in investor language. And ultimately you have to deliver on your promise and communicate the strategic assets and their value. So ultimately what these strategic assets are about is future profits. And the ones that are very successful really come from the philosophy and DNA of the business. They're enabled to create competitive advantage, and they enable scale that creates a unique opportunity that's repeatable, whether that's geographically repeating, industry repeating, and it harnesses the product and systems innovation that you've got to drive future growth. So I talked a lot of about these things called strategic assets. There is a specific list, a specific order. The top one here is having a team that can demonstrate scale. I'm actually going to talk about the first one in a little while and actually give you some cases of this, of the words talent and culture that there is a lot of press coverage for. There's lots of blogs, and if you actually look on your P&L and balance sheet, you know, where is the talent and culture line? So let's look at talent and culture specifically, because if you can't attract the right talent to deliver on your strategy, it doesn't matter how good the strategy is, nor does it matter on how well you're building these above-the-line items, because this is the gateway to getting all the credits up here. So what's amazing is that this is the same whether you're looking at a 10 million organization all the way through to a 5 billion. But the thing is, it needs to be proved. So here's an example. Company A, in the telecoms services companies, it started life with a husband and wife ownership. What they did was build internal training programs and make sure that their operatives had training at least 2 systems. They had delivery checklists, that they could walk away with a 98% completion rate, and they actually adapted their off-the-shelf job dispatching system with a predictive tool so they could guarantee response times when people arrived. A company acquired these for a 39% increase on their multiple because they could see the future growth. The industry average was 5.4. This company was sold for 7.5. Now, let's look at another company. Here is in the same industry so that we can do some comparisons. An organization wanted to acquire an IT services company. We went through a search of 15 local firms, got to 2 serious negotiations, and one company was growing, the other company was stale, and the company that was in its time was leading edge in the fact they had a ton of customer service. Clients loved them, but as expectations changed and people wanted more instant results, they didn't adapt. So the net result is the younger company that was more aligned effectively sold for a 48% premium. The other company that was here was seen as just too high a risk, and if it was going to be acquired, would have got a maximum 3 times multiple, which is 44 to 49% discount. So in every sector, whether it's technology or others, there's always a player that really focuses on talent. So for example, in the finance sector, there's an organization whose DNA reinvests, they take 1% of their profits and reinvest in their staff. The staff manage that fund, and it's all about things like golf lessons. And what they found is the type of personalities that they want to reinvest in themselves. Now contrast that with a real estate example where, to capture the talent specifically, the organization has built a university which enables them to train people consistently, develop them so that they could actually leapfrog globally their market position from number 5 to number 3. Then if we look at an aggregates industry, which is not very sexy for those that are used to technology, where the organization wanted to be number 2 in its field and recruited staff that were really happy and really good at being number 2 because they just didn't want to be number 1 and all the challenges it presented. Now, the other part of talent quite often that gets brought up, as Kathy said, is the management team. So if the management team have created a staff philosophy that's underpinning the culture and ensure that the talent delivers and actually manage the culture, then they're going to get this credit. However, if the management team are still stuck in the old ways, it has a major issue. So there's an example there where a board was resistant to a change from a print industry into online, and the people that were more online weren't aligned with the old culture. Within 2 years, this company lost well over 50% of its value. So, I've only covered the talent, and there's a whole stack of other things that drive these strategic assets. But the key things that I'm going to encourage you to do in summary in the short presentation is get your financial statements in order. Manage your assets wisely, both your physical and your intangible assets. You absolutely need to mitigate your risk, especially the ones that are out there that you're not aware of. Improve your valuation by focusing on your multiple, not just your profit. It's an and conversation. And develop an actionable share price strategy, and know the key drivers for your business, your share price, and in which order you need to do them, starting with the talent. So if you want to learn more, there's a couple of videos there, as you can see. So watch the valuation video, or read the valuation paper. And please contact either myself and Kathy, and we'll be happy to go into more detail and more specifics. And with that, I'd like to thank you and hand you back over to Ernie.
Thank you very much, Adrian, for your great content and insights. As we open the Q&A session, I'm going to go ahead and launch our second polling question. Again, those of you who are after CPE credit this afternoon, you'll have to answer this polling question and our last polling question. Again, we encourage everyone to please ask any questions you have on your end to our panelists. We have a great opportunity and some great experts here, so we hope to take full advantage of their time. My first question I'm going to direct to Kathy. And you were speaking to having your financial house in order, and someone's asking, are financial statements reviewed by independent accountants an acceptable alternative to a full scope audit in your mind?
Yes, if a review, was that the question, Ernie? I'm sorry. A review or a compilation?
Yeah. Is a financial statements review by an independent accountant acceptable as an alternative to a full audit, or maybe ask it this way: what would you suggest as an alternative to a full audit?
It would be to have your independent auditors or your independent CPA firm to help do a review of those financial statements, yes. If an audit isn't possible, then a review is the next best thing. So again, it's really making sure that you have all the necessary things accounted for in your financial statement. So do you have your revenue being recognized appropriately? Have you accounted for all your equity transactions appropriately? So yes, a review is not quite as good as unaudited financial statements, but can be helpful as well.
And I would add, if you're a manufacturing company, you need to have your stocks and inventory
yes.
independently verified, because they're very hard to rebuild.
Yes.
Okay, great. Thank you very much, Kathy. I'll direct my next question to Adrian. So someone is asking as to how would you compare, Adrian, what you're talking about, trading above the multiple and strategic assets to a 409A valuation?
Well, a 409A valuation is a very specific valuation and point in time, and most of the time its purpose is linked to tax mitigation. So, the conversation that we're talking about above the line ultimately gets realized at a transaction, whereas a 409A has to be an independent verified. And the specialists that certainly I work with that do 409As, they will actually be able to allocate the intangible assets, the comparables, but they are always going to be on a more cautious side. And you would always you'd always assume if you were taking your business to sale that it would far exceed the 409 valuation. And certainly my colleagues that are in corporate development that buy businesses, they typically would ignore those kind of valuations because they're looking to see what assets are in the business and then what can they leverage. So it's kind of a tension, driving the value of your business versus a 409A. 409A is always going to be more conservative and is defendable for tax purposes, whereas what we're talking about is the end game.
Okay, great. Thank you very much. Next question I'll direct to Kathy. So Kathy, you were focused on, part of your presentation was on keeping your financial house in order. Can you please share with us the key areas where you see that companies, either public or private, are really missing in terms of having their financial house truly in order?
Well, having helped clients with a lot of due diligence, I think that one is many companies do not have all of their records in order, whether it's contracts or, like I mentioned earlier, board minutes, they can't be found. And so I would recommend that clients set up a data room. It could be also an online, or even have one client who just had binders, and start early as you go. So it's just something that you start feeding in so that you have all your files available. They're always up to date. And you look, from a company's perspective, you look prepared. You look like you've got yourself organized and aren't searching around for something, because the more you search and the more you can't provide the right information, it creates doubt in an investor's mind. So I would say a lack of documents or where everything is. The other item I think I could see, and this is more for maybe public companies, is that being public has a lot of benefits, but it also has a lot of stress within the organization. And I see that some companies just haven't staffed adequately to meet their growth, their company's growth, or just the added burden of being a public company. And without the right staff, you can start seeing errors, deficiencies, or material weaknesses in the SOX world. So I think those are some of the biggest points.
Okay, great. Thank you very much, Kathy. I'll direct my next question to Adrian. You mentioned that oftentimes there was almost a language barrier sometimes between company senior management and the investor perspective. Can you speak to maybe the top 2 or 3 most common areas of miscommunications, and then potentially how companies might work towards so they're speaking the same language?
Well, here's some real examples. So, for example, a CEO and CFO in an analyst call talking about organic growth through acquisition. Well, this is so the analysts go, what? What on earth? Are they organically growing, or are they going to acquire the growth? So that just creates confusion. So other examples are when people are talking about, well, this is what the industry is going to do. This is what these are the trends, and the analysts going, we know all that already. What are you specifically going to do? Or yes, we're going to innovate product. Oh, great. So, but it's more of the same product. I think if we see certainly in the Bay Area, Apple's always in the news, and how the stock has shrunk, and the expectations are that every time there's going to be a new product, they're waiting for this massive new innovation. So it's just, what do other words mean? Product innovation to an analyst is actually a business line innovation as opposed to more of the same. So they're very, very subtle where they think they're speaking together, but they're not. And I would add, just to Kathy's point, that when we actually show the impact of some of those issues, like, hey, not getting your numbers out or the stress that's caused through can actually discount your stock, it's amazing how that can suddenly change the conversation, where most sales-led CEOs, whether it's public or private, go, well, I see finance as a cost. Why should I do this? And then when they start seeing how much their valuation can be discounted by that practice, we have a slightly different conversation. Mm-hmm. And again, getting your numbers out late, getting restatements because of the practices, tells the analyst that you've got a poor management team.
Okay, great. Thank you very much. I'll direct my next question to Kathy. Someone is asking, what's your view on the strategy of maintaining a stock price by borrowing and then doing a stock repurchase for a public company? Will stockholders potentially view this as a lack of control or management team ineffectiveness?
I'm thinking here. I think that the investors will look at that as, why, are you effectively using your cash to grow your business? You're using your cash in order to buy back your stock, and is that the best way to use your cash? So that might not have the effect of increasing your share price as you think it might, as the company thinks it might.
I think it's time horizons as well, Ernie, is that's seen as a move by certain shareholders wanting that to actually maximize it. But effectively, it's a short-term gain if it effectively creates a trading up of the price. But it's not a reclassification of the price. And what Kathy was, and it's kind of linked to above the line as well as below the line, what we're talking about is that the stock is reclassified, re-rated up, of which there is the trading in between. So yes, some of the things will create a short-term price high, but it'll quickly drop once all that activity's gone.
Okay, great. Thank you very much. I'm going to go ahead and launch our final polling question as we take our last few questions during the Q&A session. I'm going to go ahead and direct my next question to Adrian. Adrian, you talked about strategic assets and focus on talent. Can you share with us a few of the other key strategic assets for companies to look at and to optimize?
Absolutely. Innovation's one of them, and being able to prove what kind of innovation, whether that's product innovation or systems innovation. For example, Caterpillar, it's a well-known brand, got the credit on systems innovation because it used the way it used a CRM system to create, with its management practices, to create strategic advantage, allowed it to outperform the competition. So innovation doesn't have to be you've just created the next new mousetrap. It's about also how do you deploy that. Other examples that are well known are brand, but there's two other steps before you get to brand. And in this case, it's really how can you use brand. So if we take Apple, for example, when it was Apple Micro, that was a less usable brand than Apple. And the top one is all about scale, and others include how you're opening up channels and how you're developing and introducing new products. One thing to develop a new product, the other is your success in deploying that in your territories and using it to open new territories. They're all strategic assets, and the common thing amongst all of these is they're actually skills-based, hence why I emphasized on the talent one.
Okay, great. Thank you very much. Kathy, I'll direct my next question to you. Someone's asking, under the Jobs Act, I believe SOX is no longer needed. What are you seeing with respect to companies who are thinking about or have recently gone public?
Okay, well, so first, under the Jobs Act, the auditor attestation is not required for companies going public with less than $1 billion in market cap. So there is no exemption from management's responsibilities regarding SOX. So at first we saw that companies think that they didn't have to do SOX at all. But what we're finding is that certainly with bigger IPOs, their underwriters and auditors are requiring that companies have more robust internal control structure. So what we're seeing is that the companies are not taking advantage of the exemption under the Jobs Act. So what was seen as a benefit is a lot of companies are not taking advantage of them. So we're also seeing that the PCAOB is putting more pressure on audit firms regarding the audit processes of the internal controls of their clients. In fact, I just read something, I think that they have found them to be deficient 15% of the time, which is a pretty high number. So again, auditors are putting more pressure on clients to have an internal control structure, and so we are seeing SOX still alive.
Okay, great.
And a means of mitigating risk. So. Okay,
great. What I'm going to do is to close the Q&A session, I'm going to go ahead and share the results of our final polling question, which was about asking our attendees' reaction to the statement that their companies can impact their company's valuation relative to the benchmark. So I'm going to go ahead and share those results. So Adrian, could you please give us your reaction to those results?
That's what I'd expect. I mean, most people, before I speak to them, would be in the not sure to disagree. And when they're able to see that there is actually specific things and there is a way of achieving these multiples, then they kind of move into the not sure agree. And the not sure is we didn't give them a roadmap of how to do it, because it's one thing showing you what needs to be done. It does take quite a bit of effort to deliver on that. So it's nice to see that the skew is to the strongly agree and agree, with the not sure being able to be swayed, as opposed to if everyone was in the strongly disagree, I may be out of the job.
Okay, great. Thank you very much. With that, I'm going to go ahead and close the Q&A session. For any unanswered questions, we are going to follow up with our speakers and coordinate with them and get the answers to any of those questions on performative.com. In closing, a big thank you to Kathy and Adrian for their time and insights. They're clearly thought leaders in their fields and an excellent source of information on today's topics. Note that in the post-webinar survey, you'll be prompted to take right after the webinar concludes. You have the opportunity to express your interest in being connected with Adrian and or Kathy with just a few mouse clicks. A quick note, registration for PerformaTech's second annual PerformaTech conference is now open. The conference is all about helping companies take advantage of the current revolution in corporate finance technology to drive results across the enterprise. You'll be asking the post-event survey if you're interested in learning more about PerformaTech. Finally, a big thank you to our audience for your valuable time. We hope to see you again soon at another Performative event or online at www.performative.com. Thank you very much, everyone, and make the rest of your day great.